Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.isc.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, good afternoon, everyone. It is 3 p.m. here in New York, and thank you for joining us this afternoon. Today's session will be with ISE's own Mark Abssy, and the topic is liquidity. ETF liquidity, it's not what you think it is. This is actually a special session that we're holding during market hours, and this is to give you a look at what's going on in the markets right now. We should have time for a little bit of Q&A also at the end. So just a little bit of background on Mark. He is the Index and ETF Manager for the International Securities Exchange, and he's responsible for all phases in the development of innovative tradable products, from concept all the way to commercial launch. And prior to joining us at ISE, Mark held various product management positions on the institutional client side, as well as positions managing short-term investments. So I'm going to go ahead and turn it over to Mark for this afternoon's session.
Okay. Thanks, Katrina. I'm assuming that everyone can hear me. WebEx tells me I'm now the presenter. So I'm going to start things off here and do a little sharing with, let's see, I will share, what am I going to share? Application, desktop, okay. All right, bear with me here. Oh, that's strange. Okay. Sorry. Ah, here we go. Just waiting on the networking here. So this is good. Hopefully you all are having a good day, good trading day and all of that. Today we're going to talk about, or what I'm going to talk about, and your guys hopefully will chime in as well, is ETF liquidity. And I'm hoping that everyone can see the Excel screen in front of them here.
Yep, we can see that.
Okay, good. So I'm going to talk about ETF liquidity, what people generally believe it to be, and then really what it is. Okay. And really what it is and kind of how it works. And in explaining this, we're going to touch on a few different things. Primarily, we're going to talk a little bit about the creation redemption process with ETFs. We'll just touch on limit orders and their usefulness, and then again, probably where to find some of this data, some of this information. So when you look at the page here that's up, you see that I'm looking at two products here. One is PHO, which is the PowerShares Water Fund. And then the other is FIW, which is the First Trust Water Fund. And you, like a lot of other investors, will look at these products from a liquidity perspective at a high level, and say, if I were to ask you which one of these funds is more liquid than the other, you would say, well, of course, it's PHO. I mean, look at it. It has over $1.1 billion in assets. When you look at the volume for the current day, that line 10 there, column C10, the current day volume, if you look at that, you can say, well, geez, PHO is traded 170,000 shares, FIW is traded, 5,500 shares. Indeed, if you look at the daily 3-month average ADV, as you can see highlighted, it again is about 10 times. And so, your average investor will say, gee, I want to get water exposure. What's the best way to do it? Geez, here's this fund. It's the biggest, and it looks to be the most liquid, so I'm just going to write my ticket there. And for a lot of people, that's kind of where the conversation starts and ends. But when you look at what really is happening with ETF trading, it's not always the case of what is going on here. So one of the things I'm going to do, I'm going to come back to this page, but for now I'm going to flip down to this other page here, And I know there's a lot of numbers here, and there's lots of things that are going on. But basically, this page here is basically the basket for FIW, for the First Trust ISC Water Index Fund. So when you look at the highlighted column here, these are all the holdings in the fund. This second column here that I've highlighted are the weights of those holdings. As you go along here, when you talk about weights and you talk about baskets, first off, sorry, I think I got just slightly ahead of myself here. When you talk about baskets and you talk about creation and redemption activity, generally speaking, a so-called ETF basket is the equivalent of 50,000 shares of the ETF. Okay, so if you have a trade that is a couple hundred shares, 1,000 shares, you're going to put your order in, and it'll get filled on just the regular book. It'll just hit the order book, and based on outstanding liquidity, your trade will get matched up, and it'll get executed. When you start to talk about larger trades, 100,000 shares, 200,000 shares, what ends up happening is that you may even be a so-called AP, an authorized participant, but you will go out to the market and you will actually buy, in this case, a number of shares of each of these holdings in this configuration. Go out and buy this basket and then deliver it to the fund company. They will say, thank you very much for this share basket. Here in return are your shares of the fund. All right, so like I said, share baskets, creation units as they're called, are 50,000 shares worth of the ETF, which in this case, as you can see, is worth 17,000 shares of this stock, 12,000 shares of that, 1,100 of this, etc., and so on down the line. And so when you're talking about liquidity, right, I'm just going to switch back to the first page here. We can look here and say, okay, there's a lot more volume in PHO. Up here on the top left, I have this theoretical trade of $1 million, right? And so when we look at $1 million, if I were to place $1 million trade in both PHO and FIW, I'd be buying about 53,000 shares of PHO. I'd be buying about 44,000 shares of FIW. In both cases, whoever is managing this trade for you might just go out and buy a basket and just say, you know what, this is close enough to a creation unit. I'm a large enough player in these anyway. I'm just going to go out and buy the basket. Okay. Now, when you look down here at this level here, this is the ETF percentage ADV, which means it is the average dollars traded in a 5-day period, or the average daily dollars traded. So if I have $1 million that I want to put into PHO, that's going to be about, call it 29% of ADV of PHO for any given day. For FIW, it's going to be 400% of ADV for any given day. And again, this is looking at these funds at a top level, right? This is based on the, say, whatever it is, a couple 100,000 shares of PHO trade every day, and 20,000 trade in FIW. So when you look at the top level, you say, well, geez, I can't be 400% of daily ADV for this fund, but at the same time, you also don't necessarily want to be 30% of ADV for the other fund, even though it is a large fund, right? So you're going to go, you or your AP are going to go to the market, put together this creation unit, these baskets, and look to deliver them and then get the shares of the fund. Now, something kind of interesting happens here is that the sorry, I have too much going on. Go away. What ends up happening is that when you go and you put together these baskets that we talked about. It turns out that the basket, which is 29%, or the trade, the $1 million trade, which is 29% of the day's trading for PHO, turns out to be only 53 basis points of the trading of all the underlying components. All right, and let me talk about that a little bit here. And then even then, with FIW, that 400% that we see here, putting $1 million through the fund, at the fund level, at the share level, that's 4 times a daily ADV. But when you look at it in terms of the underlying securities, it's actually less than what it is for PHO. It's only 37 basis points of ADV for the underlying components. Okay, now I'm just going to flip back to this other page here, and let's look at what that ADV figure, how we get to that. Okay, so if I look at, let's just take, let's see, let's take this line here, and we'll highlight it. All right, so we're all looking at Flow International Corp, ticker's FLOW. It's about 3.56% of FIW. Now, we've determined, based on pricing and everything else, that we would need to buy close to 12,000 shares of this. The weight in dollars, again, we take this 50,000. You can see the formula up here. 50,000 shares times the last price of the fund gives us a total dollar amount, and then we're applying the weight of this particular security to this. So 50,000 shares, that's whatever 50,000 times 22.54 is, and by the weight, you're going to get this $40,000 that you're spending on this. So here we have the last price, which is the last traded price, and then the next 2 columns here are the bid and the ask. And in this case, this particular company is about as tight as you can get. They are a penny wide. If you look down the list a little at, say, Lindsay Corp, where I'm just highlighting here, you see that Lindsay Corp is 6 cents wide. And this is something that I'll touch on a little later when talking about kind of markets for ETFs at a high level, which is, there's 6 cents in between the bid and the ask there. And a lot of people that I talk to will look at a fund and say, geez, I think I like the fund, I like the returns, but it's really wide. It's trading 10 cents wide. It's trading 15 cents wide. I don't want to, that's really wide, and I don't want to put in my offer and just put in a market order and get that. And I tell people, well, then don't. I mean, the bid and the ask are kind of almost like price recommendations. They're the market telling you that that's what they'd really like to get, and if you want to pay that, then that's fine. But if there's a spread in there, like right now, this is now 11 cents wide. You can see the last trade went off at 65.32, and right now it's 65.26, bid 65.36. If you wanted to trade, there's no reason why you couldn't go in at 32. It's not too far off of what just traded, but there's no reason for you necessarily. Now, see, it came in again, but there's no reason for you to be right at the offer all the time. And even though it may be a penny or 2, maybe 3 that you're saving it over however many shares you're trading, and over time, however many trades you make. And certainly, I mean, it's been over a year now, but I think people still hopefully have learned a lesson about putting in market orders, because market orders, 98% of the time you'll get your fill and everyone will be happy. Sometimes the market will move on you and you'll end up getting hosed, and nobody wants that. So I hope everybody here understands what a limit order is, and I hope that they all use them, because whether you're trading stocks or ETFs or options or futures, use limit orders because these things will move on you, and if you have some fast markets, it can end up being pretty disastrous. All right, so that's my spiel on limit orders. Back to our topic here about spreads and the weighted spread and the ADV and things. So we have our bid-ask on this. We're a penny wide. We see this here that usually trades about, say, $3.4 million a day. Market cap, it's a $160 million company. And this is something that we'll get to a little later. And this is here is the trade percentage of ADV. And this is where we want it to end up. So the percent of ADV for this, if I'm putting $1 million into the fund and I have to go buy baskets for this, my trade in this is going to end up being a little over 1% of the ADV in this particular name. All right, so, and again, I'm taking that $1 million, I'm applying the weight of the name to the $1 million. I'm coming up with a dollar amount, which in this case is this $40,178. When I look at ADV for this particular name, it's $3.4 million. It gets to be about 1%, right? So I can take all of these and I basically average them, and I get to my 37 basis points, which is how this is how I get to that 37 basis points of ADV on that trade. I don't know, Katrina. When I went to show my Excel screen, the other screen went away. I don't know if there are any questions at this point, or.
Let me go back and check. Nope,
Okay.
not yet. If any of you have a question on an ongoing basis, just make sure to let us know in the Q&A or the chat window, and we can cover those at the end.
Okay. All right. So here again, this kind of reinforces a little bit of what I was talking about. When you look at liquidity and you're looking at kind of the top line numbers here, when you look at the spread. So here I've selected what the current spread on these ETFs are. You can see that PHO is trading a penny wide. FIW is trading 3 cents wide. And again, a lot of people would look at these numbers coupled with the volume of the current day and say, well, geez, you know, why would I even want to buy FIW? Because it's 3 cents wide, PHO's one cent wide, and there's so much more volume in PHO. I have no reservations about putting a trade in, writing a ticket on PHO, because I know I'm going to get filled. And you know, people feel that way. I guess they feel that way. There's nothing you can really do about that except to, you know, let them know or show them that, okay, these may be wide or not as wide as the other, but if we look at this, you know, basket spread here, right? You know, FIW's basket's trading about 2 cents wide, and PHO's basket's trading about 2.5 cents wide. It's not a huge difference, right? It's about a half a penny. But when you're talking about someone who's doing this on an institutional level or actually writing big tickets, you know, this stuff adds up. And I would say that, you know, depending on how you look at it, I would actually state that FIW is actually a more liquid product than PHO. And we see it here in two numbers. We see it that the basket is has a tighter spread of about a half penny. And we see it here in that this, if I flow $1 million through this product, I'm only trading 37 basis points of the total basket for FIW versus 53 basis points for the basket for PHO, right? And indeed here, when you look here down in these areas, average component ADV, maximum component ADV, you know, these again are figures that will speak to that liquidity here. Now, on an individual name basis, right, there seems to be a slightly smaller name. If you want to look at the smallest name in both portfolios, there seems to be a slightly smaller name in FIW than PHO. And this maximum component ADV figure speaks to, if I am going to flow $100 million, or sorry, $1 million through the fund, there is a holding here in FIW, which is going to be, about 3.5% of ADV, and then the kind of most illiquid one in PHO is only about 2.4%. But again, at an aggregate level, at a top level, you have basically a more liquid, more tightly priced basket in FIW than you do in PHO, right? If I change this and I say, let's say, I'm going to make a trade, and I go in and I say, okay, what am I going to do? I'm going to do, a $5,000 trade, which is probably what I would do if I were to. Now, we see here that things change, right? My $5,000 trade against 5%, against 5,500 shares for the day, or even the ADV, it goes down to 2% of ADV for FIW. Of course, it's a much smaller number for PHO. But the point is that $5,000 trade, that ticket, if you feel that there's more security in just using, the more heavily traded product in getting your trade filled, I guess that's kind of your prerogative. But at the same time, that $5,000 ticket, the $10,000 ticket, that shouldn't be any cause for concern with regards to liquidity. Your trade will get filled. Again, use a limit order if you feel that, in this case, 4 cents wide is too wide, and you want to tighten it up to where PHO is. Bring it in a penny, see what happens, right? I wouldn't recommend going right to the midpoint because, of course, that's just how market makers make their money, is on the spread. But I always tell people any fairly priced limit order will get you filled, and it'll save you money off the offer, off of just putting in a market order.
Mark, we actually do have one question
okay.
from one of our participants. He wants to know if option liquidity should be consistent with the underlying stock.
I don't know if it should be, but definitely we have seen that option liquidity begets underlying liquidity. So I don't think you can kind of have option liquidity without having underlying liquidity, just because market makers always want to hedge themselves. It's kind of, it's not really a chicken and egg thing, but you'll generally see that option traders want to trade something that they're going to see some volatility in, that has good markets from a liquidity perspective, and then of course the other way around as well, that guys who are issuers like to see the options activity because they know that people are either using the hedge or they're speculating. But the bottom line is that whatever position they put on, somebody has to take the contra position, just because no market maker is not going to leave a position unhedged. So I don't know if that really answers the question. I think the last time I was on, I talked about a small study that I did regarding SPY and options activity in SPY. I basically ran kind of a back-of-the-napkin numbers using put call ratios and outstanding interest in options on SPY, and figured out from a period of the year-to-date period in 2010 to September 30th, figured out that on average of the average 70 billion in SPY, that about 1.6 or 1.7 billion of that was really due to kind of a constant churn of market makers hedging their their put positions. Right. So, of course, SPY is unique in that it's just has such high volume of trades, both in the spot market, and the cash market, and in the options market. But yeah, there are definitely issuers like to see options activity, and vice versa. Option players like to see strong trading in the underlying. Okay, I don't know, Katrina, if there's any other follow-ups on that.
Actually, we have one question. Nicole says she follows your logic with how to compare the two ETFs. However, aren't you assuming that the two ETFs offer nearly the same exposure to water?
Well, this is where it gets interesting, and this is where, unfortunately, I can't go too much further into it. I mean, you can certainly look at the names. Part of the decision in making, not part of the decision, but part of the decision process in making an investment decision is, of course, evaluating what you want to put into your portfolio. I think that, generally speaking, a lot of investors have been kind of programmed or have been taught that ETFs are index-based instruments. Indexes are passive, and therefore Index A as compared to Index B, there really is no difference. However, and I'm not just saying this because I am an index developer and provider, but really in an index-based product, the index makes all the difference. And so what you want to do, not only in this case, but in any case, is really look at what is this fund really giving me. I know people often have said, oh, at least once in your life, read a prospectus. I agree with that. But I would also add that if you're doing some serious research on an ETF, find the index provider, find out who that is, go to their website, and read the index methodology guide. Because the index methodology guide, while referenced in the prospectus and referenced in the collateral material for the product for the fund, really gets down to exactly what is going on. And it may be a little dry, and there's definitely going to be some math in there and that sort of thing. But check these things out because they're a lot more accessible, a lot more kind of user-friendly than your average prospectus, and they will ultimately tell you, I think, more about what's really going on in the fund or the index, I guess, than kind of reading through the prospectus. But with regards to having the same kind of exposure, yes, both of these products give you exposure to the water industry. I'd leave it up to you and encourage everyone to go and pull up some quick performance history. Pull up some numbers. If you go both to PowerShare site and to First Trust site, they will have some attribution analysis. They will have some history there, and you can see very easily, very quickly, which one of these you might want to put in your portfolio if you're looking for this kind of exposure. So.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.